There is a brand new kid on the EV block that is not only taking Wall Street by storm, but also the broader electric vehicle community here in North America. Yes, folks, you heard that right. Fisker Automotive, founded by the once defunct Hendrik Fisker, who happened to go head on with Elon Musk at Tesla, is completely revamping its business strategy and has actually started to deliver real vehicles. The company's first product by the name of the Ocean has officially launched and is delivering at a potential rate of 300 units per day with the manufacturing partner that Fisker has worked with called Magna. Fisker also just so happens to be one of the many EV stocks that is publicly traded via a SPAC here in the US markets, which leads it not only more criticism by the Tesla community and other electric vehicle investors, but also by those of Wall Street when it comes to understanding profitability, ramping up production, and the real advantage that this company has. And as we have just started to see the first few Ocean units launch onto the market and into independent reviewers' hands, we're starting to get a good picture as to why the Ocean might actually be competitive in a heavily saturated EV market, not only in Europe, but also here in North America. What exactly are those advantages? How does Fisker Ocean's pricing strategy compare to its other nearby automakers, as well as understanding Fisker's financial statements, are exactly what we're going to address in this video. But as usual, folks, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, folks, let's address the big news this week out of Fisker's PR department, where they mentioned upping their production guidance for the fourth quarter of 2023 by 66%. That is a pretty impressive improvement for a company that has only yet started delivering vehicles to customers in the US. That results in a potential delivery target of 300 vehicles per day going forward, as the company has already produced their 5,000th vehicle out of their contract manufacturing facility in Austria. Now, I'm sure the word contract manufacturer is a new term for many of you, but essentially what it means is that Fisker is outsourcing its manufacturing, its testing, and validation to a third party, in this case a company by the name of Magna International. And believe it or not, using such a contract manufacturer has been a popular scheme not only for the automotive industry, but also for something like consumer electronics, with companies like Apple, Dell, outsourcing their manufacturing to companies like Foxconn. And as it turns out, Magna themselves have had good experience building successful vehicles like the BMW 5 Series from the same plant that the Fisker Ocean is currently rolling off of in Austria. And this right here, folks, is the simple reason why Fisker has been able to launch its product into the market faster than really any other EV startup in the past really has. Because instead of building capacity by themselves, they're lending a helping hand from Magna to construct their vehicle, resulting in better gross margins as well as a better forecast on their production and potential delivery guidance. And from an investment standpoint, this makes perfect sense for a startup, even though in the long term there are going to be royalties that the company is going to have to take a hit on when it comes to the CM partner and its contract obligations. And guess what, folks? So far from the reviews that I've seen, the Fisker Ocean, having delivered in around 700 units here in the US, is actually a really nice crossover vehicle. Not only does the design stand out, but the sustainability focus that Fisker has with its brand is really playing well in hand with a lot of customers that have that same mindset. Not only is Fisker starting its business by selling in the best-selling segment in the US, which happens to be the crossover/SUV, but it is also selling a product that has great efficiency, great practicality, and some unique features that can give it an advantage over competitors like Tesla, Rivian, and even the likes of Kia and Hyundai. With a starting price of $37,000 with a base model range of 250 miles and a peak power of 560 horsepower, the specs of the Fisker Ocean really do set it apart in its broader category, with its potential direct competitor obviously being the best-selling Tesla Model Y. Not only is the Ocean, in my opinion, better looking, but it has some new features that other vehicles simply don't have, with its California mode, as well as its extra spacious interior, which is completely driver-centric and has quite a lot of customizability in the form of features, functionality, and even materials. And from the reviews that I've seen so far, although there are some plastic and rubber bits here and there in the interior, most of the interior is very high quality, even for the $37,000 model, which happens to be well below the price of something like the Model 3 or the Model Y. Factoring in a $7,500 tax credit from the government, and there are a lot of things to like about the Ocean, even though it is a first-generation product. And because of this, from a fundamental perspective, it is also very easy to see why Fisker could break even sooner rather than later, resulting in good rewards for patient investors. What using a contract manufacturer allows Fisker to do is completely ignore and avoid the overhead costs of running their own manufacturing plant that, let's say, has a capacity of producing 5,000 units per year. But if their supply chain and their customer demand only goes to around 2,000 units per year, then they are down on their profit margins, and naturally investors are going to be skeptical about the timeline of breaking even. But because they are working with Magna International, Fisker has the ability to ramp up production at a much higher precision rate than any other EV startup in this space, which results in better profitability in the short term and reduced cash burn, even if, yes, in the long term, there are going to be obligations between the two companies that could hurt the development of new products. Now, this doesn't mean that Fisker is going to put in lossless quarters going forward, because they still have to spend a lot of money on marketing and R&D, which is not going to cover any of their expenses from production. But compared to other EV startups, Fisker certainly has the right amount of cash to potentially be able to weather any sort of short-term volatility. And as a result, there's a really high likelihood that you're going to see more Fisker EVs on the roads here in the US, with it potentially being one of the only successful EV companies apart from Tesla. Now, granted, the company does have quite a lot of debt in the long term, north of $1.3 billion, with their current debts also being quite hefty at $586 million, which means the company is going to have to potentially raise more money or through credit lines to really help them alleviate this problem. And certainly that's going to be something that's going to weigh on the valuation of this company, which currently happens to be sitting at around $2 billion. I certainly do think Fisker has turned around a corner and is potentially on the track of viably launching a new product that could certainly be very successful. As usual, folks, let me know your thoughts on Fisker down in the comment section below. Thank you very much for watching, and I'll catch you guys in the next one. Take care.